QuickBooks Pro Desktop 2021 Inventory Tracking Options. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file homepage. We have the open windows open. You can open the open windows by going to the view dropdown and selecting the open windows list. Last time we took a look at the service items and discussed how those service items will be functioning within the QuickBooks system. We're going to move on to the inventory items, but before we do so, we want to discuss the differences between the inventory items and how they will work, because they will be a bit more complex, and that'll help us with the data input process. So the inventory items are going to have the same function. We'll see them down here when we create a invoice and a sales receipt, but there's also going to be an added piece to the inventory in that if we're doing a full inventory system, as we will practice doing in this practice problem, we will then be purchasing the inventory as well, meaning the inventory item that we will set up may also be used if we use purchase orders, and we may or may not use purchase orders. We will in this practice problem, or when we enter a bill, when we purchase, in other words, the inventory. So then when we purchase the inventory on a typical inventory perpetual kind of method, we would put the inventory on the books as an asset. We wouldn't expense it at that point in time. We put it on the books as an asset. And then what happens is when we sell the inventory, we'd have to use either a sales receipt or a invoice or a sales receipt. That's when the perpetual system would decrease the inventory. Now, if I take a look at a sales receipt, what we will expect to happen on the invoice, we're going to have our inventory item. We only have service items now, but if we had an inventory item, we would do the same thing that the service item would do, and then a step further. In other words, we would have the same thing the service item did, was to increase revenue and increase accounts receivable with this item. Now, if it was an inventory item and we were tracking inventory in the system, it would also be decreasing the inventory at this point in time and recording the related expense called cost of goods sold, even though those two amounts will not be on the invoice. We also may have to assign sales tax to the inventory item as well, because oftentimes the inventory item will have sales tax applied to it. So the invoice, although it will look very easy and simple, it'll be easy to populate, will be having a much greater effect and impact on the tax return, on the financial statements. So as you think about the inventory, now note that you may not want to do the inventory tracking within QuickBooks. You might choose to do some other method. If you do the inventory tracking through QuickBooks, it can be a little bit more complex because you are using a perpetual inventory system, recording inventory every time you record a transaction. You're not using a periodic system. So you might want to use like a periodic system. And if you have questions with inventory and how to track inventory, and just in terms of the general flows of inventory, the methods you can use, specific identification, first in, first out, last in, first out, and weighted average method, we have a course on that. You might want to get some background on the inventory flows and then think about how you could fit the inventory flow into whatever workflow will work best for you. So because it can be a little confusing to track the inventory in QuickBooks. You might want to, rather than track it in QuickBooks, I'll go over some of the different methods that you might want to think about. One is you could try to use like a cash basis method. Now, again, this you want to talk to your accountant about this and see if you can do this for taxes and whatnot. And it would only really work if you had limited amount of inventory on stock, right? But that would be the easiest thing to do. So in other words, a cash basis method would not, when you purchase the inventory, I would just pay for the inventory, entering the bill here to pay for the inventory. And instead of recording an asset of inventory that we expect to sell in the future, we would just expense it at that point in time as cost of goods sold at that point in time, not dealing with the asset, because that asset account of inventory is an accrual account. We're recording an asset instead of an expense. So if we would just record the expense at that point in time, then when we create the invoice, we can just simply do the same invoice we normally would for a service item, increasing the sales and increasing costs and increasing the sales and increasing accounts receivable, not dealing with inventory, because it would have already been recorded up top when we purchased the inventory. The problem with that is that the timing is off. That's why the accrual method doesn't like that, and the taxes won't like that as well if you have a lot of inventory. So you won't be able to do that unless if you have a substantial amount of inventory. But if you have a small amount of inventory and you sell the inventory very quickly, like if you're doing construction jobs and you buy inventory and then you use it right for the job at that point in time, then it might make sense because the timing is pretty close to itself, and it would certainly be the easier thing to do to just expense it. But of course, if you have more inventory, you're going to want to track the inventory flow. Now, the other method that you could use is, instead of me recording, as we would in QuickBooks, and instead of me recording the sale every time I create an invoice or a sales receipt, instead of decreasing the inventory incrementally every time we make a sale, we may simply want to do a periodic system in which we would basically record the inventory when we purchase it. So now we're putting it on the books, back to the accrual method, recording the inventory when we purchase it, but then we're going to record the decrease in the inventory periodically after we do a physical count. So you can imagine basically increasing the inventory and then just recording the sales as you normally would, not tracking the inventory through the system, tracking it on an Excel worksheet, and just simply entering the data into the system, debiting inventory, crediting the cash that you would have, instead of tracking the actual units of inventory, then recording the sales just as you normally would, just like a normal service item, and then periodically you're going to count the inventory and record the decrease in the inventory, recording the cost of goods sold and the decrease in the inventory periodically with the physical count. That would be a periodic system, and again, that might be a more simplified method than recording the inventory through the accounting system. If you record it through the accounting system, as we will do here, then you're using a perpetual method, and you'll be using a weighted average method, recording the decrease in an inventory every time. So again, to get more detail, you could take a look at a course on that. I highly recommend it if you're tracking inventory, so you can kind of figure what the best method for you is. But let's just take a quick example of this. If we were to take a look at a perpetual first in, first out. Now, this is the most common method, probably not the one used by QuickBooks. QuickBooks uses a weighted average method, but this is probably the most common method. And it makes sense to people's minds because this is how you would imagine the inventory to flow in a perfect world, right? So let's just imagine here the inventory. This is a standard kind of worksheet. We'd say, okay, well, if I started with inventory of 100 units, this is units, not dollars, and they cost me $50, that means the inventory on the books, I'm going to say that we started at, was $5,000 worth of inventory. We would have to track the dollars, 5,000, and the inventory, 100 units. Let's say we then purchase another 400 units. They now cost us $55, a little bit more per unit, even though they're the same units. That would mean that we now have another 22,000 in total units. In a first in, first out method, now we're seeing two layers of units, even though they're the same units. One layer at 100 units at $50, another layer 400 units at $55. If we add those up, that means $27,000 worth of inventory. So we're at $27,000 worth of inventory, but they're broken out into two different dollar categories because the price of them went up even though they're the same items that we had, right? That's part of the problem with the inventory. When we make the sale here, let's say we made a sale now, we're in terms of just the cost side of things, the sale would be increase in sales, the other side going to accounts receivable. On the cost side of things, we would have to record the increase in the expense, cost of goods sold, each time we make a sale, and we would have to record the inventory, decrease in inventory. And we would have to break out now. We'd have to say, okay, which units did we sell? And we're going to say, okay, we sold 100 units of the oldest units and 320 of the newer units, adding up to the 420. That's what first in, first out means. So this is what this amount then in dollars is what would be recorded on the books as an increase in cost of goods sold and a decrease to inventory. And then the balance sheet would still have inventory on the books, and that would be equal to the 100 units have now been wiped away, so they're gone. And then we had 400 units at the 55 are now down to only 80 units. So now we would be on the balance sheet left with 80 units. Now, if we were to record this in the books, that would be at the dollar amount of $4,400. but we would also be tracking the units that we had, which is 80 units at the $55. And you can see if we purchased more, then we would increase the layers here and so on and so forth. Point here being that we're tracking this perpetually. So this would be as if we created the invoice and we're tracking that every time we create the invoice. Now, you could do it periodically, which could be a little bit easier, or depending on what your system is. You could say, well, look, what I'm gonna do is I'm just gonna increase the inventory every time I make a purchase here. I'm just gonna increase the inventory every time I make a purchase, and that'll increase my inventory, and then I'll just record it straight into QuickBooks, perhaps with a journal entry. The journal entry simply being whenever I make a purchase, I debit the inventory and I credit the cash that I paid, either cash or accounts payable. So I'm just going to do that every time. And when I make a sale, I'm not recording the sales in terms of the cost of goods sold. I'm recording the sales revenue, sales side, just like I would with a service item, increasing sales, increasing the accounts receivable, but I'm not recording the cost of goods sold side increase or the decrease in inventory. I'm just gonna make it really easy in QuickBooks, and then at the end of the month, what I'm gonna do is I'm gonna count my inventory, and then I'm gonna record the decrease in the inventory in my worksheet on a perpetual basis. So now I'm gonna say, okay, now at the end of the month, I'm gonna determine how much inventory I have left. I'll use my worksheet then to figure out how many units I have left, and what then the ending dollar amount is left in terms of units, in terms of dollars at that time. And then I'll make a journal entry in in QuickBooks, that will debit for the entire time period, in this case a month, for a debit to cost of goods sold and a credit to cash, credit to inventory, decreasing the inventory periodically at the end of the time period. And so you can use this method. If you use this method, then you're not tracking the information in QuickBooks, which can be a little bit easier, and you're simply doing it periodically based on basically a physical count, which you can do daily or you can do monthly, or so on and so forth. You could do a similar thing if you wanted to use the average method. I'll put this worksheet. You could do it. You do the same thing with a weighted average method. It's just a different kind of calculation. But if you have questions about those methods that you can use, then take a look at our course on the inventory flow assumptions. Once you understand the flow assumptions, then you want to go in and say, okay, what would work best for my system within QuickBooks? Inventory is not like a one thing fits all kind of method. You can use a periodic method, you can use a perpetual method, you can use first in, first out, last in, first out, weighted average. If you track the inventory in QuickBooks, then you will be using a perpetual inventory method, and you will be using the weighted average, which is good. That's a solid method. But you just want to make sure that fits, that you understand, what is going on with that. All right, so next time we will then start to create the inventory items, and we will be tracking it in QuickBooks in our practice problem, so that we can track the units as well as the costs, and we'll be doing so with a weighted average method.